Roth conversions have the potential to save you tens or hundreds of thousands of dollars in taxes over the course of your retirement. But if you don't know the key decisions or the key factors to look at when making this decision, you'll likely do it wrong and leave a lot of money on the table. In today's video, I'm going to walk you through the things you need to be aware of so you can make the best possible decision around Roth conversions. Hey everybody, I'm James Canal, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. When you first look at Roth conversions, it may seem simple enough. The key decision, or the most simple decision at its core, is will I be in a higher tax bracket today, or will I be in a higher tax bracket in the future? If I'll be in a higher tax bracket in the future, I'll do conversions today. If not, I won't do the conversion. Now, that's a good place to start. But if that's where your decision starts and ends, you're likely missing the most fundamental pieces of this decision. Now, let's start there because that's a good foundation, and then we'll build on to see what other things should you consider when it comes to making a Roth conversion. Well, if you're going to be in the same tax bracket today as you will be in the future, it really doesn't matter. And I should specifically say marginal tax bracket. Let's look at an example. Let's assume you have $10,000 in a traditional IRA and you want to know, should I convert that to a Roth IRA? Well, let's assume that today your marginal tax bracket is 20%, and let's assume that in the future it will also be 20%. Let's also assume that whatever your IRA is invested in will double over the course of the next 10 years. How would that conversion play out? Well, let's assume that you did the conversion. That $10,000, you pay 20% taxes on it, so you're left with $8,000. Now we know that investment doubles over the next 10 years, so $8,000 turns to $16,000 tax-free in 10 years. So $16,000 tax-free is what you'd have if you did the conversion today. Now what if you don't do the conversion today? Well, you'd have $10,000 pre-tax. We talked about that investment doubles, so $10,000 turns to $20,000. You're still in the 20% marginal tax bracket. So if you pull $20,000 out in 10 years, after paying 20% taxes, you're left with $16,000 after tax. So $16,000 after tax and $16,000 after tax, it's the exact same. So what that would lead us to believe is it's as simple as understanding higher taxes now or higher taxes in the future. And as I mentioned, that is the right place to start, but there's nuances to it that if you're not getting it right, you might miss this and convert the wrong amount. So there's 4 things you need to add on to this analysis to make sure that you're doing it right. The first is try to understand where will tax brackets be in the future. Now granted, this is an impossible thing to predict if you're trying to predict over the next 10, 20, 30 plus years. What do we know? We do know that after 2025, current tax brackets will sunset and rates will go up. On average, each tax bracket will go up by about 3 to 4%. Now that's clear enough to know, but when you're doing this analysis, what I see too many people look at is they look at just today's tax brackets and assume it will be the exact same in the future. Well, at a minimum, start calculating or start understanding what will tax brackets be based upon new legislation. I shouldn't say new legislation, but 2026 law, where it will revert back to old tax brackets. Start there. Also understand or also start with a historical understanding of where do we stand today with tax brackets. Today, tax brackets are relatively low compared to where they've been historically. Now, as we look at that, as we look at where government debt is, as we look at a whole bunch of different factors, if we had to guess, it's probably not all that unlikely that tax brackets will go up in the future to pay for some of the government deficit to revert back to where it's been in the past. Now, can you predict that? Absolutely not. Should you try to predict it? Of course not. But we do need to have some understanding of where do we stand historically and what's likely to happen in the future, because one way I encourage people to view Roth conversions is almost like tax insurance. When you look at something like insurance, you hope you don't need to use it. The example I'll give is I have life insurance on my life. I hope my wife never has to use it. I hope my life insurance policy becomes a huge waste of money. Now, if it is needed, I'm really glad I had it. But if it's not needed, it means I got something even better. It means I still have life. It means I'm still living and the policy was never needed. How does that apply to Roth conversions? Well, if we think of Roth conversions as like tax insurance, well, if you don't need it, if you end up converting more than you needed and tax brackets go down in the future, overall, that's a good thing. It means things overall are better for your entire plan, and it costs you a little bit to get that insurance premium of hedging against what could have gone wrong. Now, if you do need it, because tax brackets go up substantially, well, you're glad you had it in the same way I'd be glad I had a life insurance policy if something happened to me. So there's not a perfect science to this, but understanding where we stand historically with tax brackets, understanding what we know will happen in 2026, that's a good starting point for how to factor out or how to play out how to view Roth conversions in the future. The second nuance to this is people too often focus only on what their cash flow income will be in the future. What do I mean by that? Well, when you're comparing Roth conversions, you want to know what's your taxable income today and what will your taxable income be in the future. Well, taxable income in your working years, it's pretty easy to figure out what that is. If your salary is $100,000, your taxable income is probably $100,000. Maybe some interest or dividends or rental income if you have property, but it's majority going to be your salary. If $200,000 are your wages, that's going to be your income. Well, in retirement, people think, oh, I maybe want to live on $50,000 per year or $70,000 per year or $100,000 per year. Whatever the number is, that's the number they think of, and they compare that to how would that be taxed. Well, here's the thing about retirement. In retirement, you create your own income through a combination of Social Security, dividends and interest, IRA withdrawals, other income sources. The thing about that is all those income sources are taxed differently. So it's less about what's your cash flow in retirement, so cash flow being how much income do you have coming in, but it's more what is that cash flow comprised of? What is that income comprised of, so we can get an accurate assessment of what will the taxable implications be of that level of income. So for example, if you have Social Security coming in, at most 85% of that will be included in your taxable income. So $20,000 coming in from Social Security doesn't mean that you have $20,000 of taxable income. It will actually be less. We'll compare that to an IRA withdrawal. Anything you pull out of your IRA, that's treated as ordinary income, 100% of it. So that's taxed differently. Then maybe you have some interest from Muni Bonds. Well, that's cash flow, it's income, but it's not actually taxable, so it's not included in your taxable income. Then maybe you have some long-term capital gains or qualified dividends. Depending on your income, that's either tax-free if your income is under a certain level, or you're paying taxes but at a capital gains tax rate, not an ordinary income tax rate. So the point of this is when you start adding up capital gains and dividends and interest and IRA withdrawals and Social Security, it's not enough to know what's the total amount of income that is. You need to know what's the taxable amount of income, because when you're comparing Roth conversions, it's all about what's your taxable income today, what marginal bracket are you in, versus what would the marginal tax bracket be that you'd be pulling those funds out in retirement. And you could very easily have $100,000 of income in retirement, but your taxable income might only be $60,000 or $50,000 as an example, depending on how that income is comprised. So do your best to understand not just what will income be in the future, but what will that income be comprised of and what tax bracket would you put that in, so you can do an accurate analysis of where do you stand today and what might your taxable income be in the future. The third nuance people need to take into account is what will be the impact of required minimum distributions. So often people retire and then they look at the first year of retirement and they say, oh, my tax bracket's not that bad. I can stay in the 12% bracket or below based upon how I'm pulling income out of my portfolio. And for many people, that could continue all the way throughout retirement. But for those who have done a great job of saving to their 401k or building up pre-tax IRA balances, there's a ticking time bomb called required minimum distributions, where once you hit a certain age, under new rules, is anywhere between 73 and 75, you're going to be required to start taking distributions from that. So it's not enough just to know what income do you want to live on in retirement and understand what tax bracket that will put you in. You also need to understand from 73 and beyond, what income tax bracket will you be in based upon forced distributions. So even if you're saying, hey, I'd be totally content with $60,000, $70,000, $80,000, and that's going to keep me under a 12% bracket. Well, that is great until 73 or until 75 when RMDs kick in, but what's the impact of those required distributions? I see many cases where people go from the 12% bracket easily into the 24% bracket or higher in the future. And by the way, those would be actually higher rates in the future, so 28% or higher, because of the impact of required distributions. So understand how that would actually impact your projected income through retirement so you don't run into any challenges that are based upon withdrawal you're required to take, not necessarily that you want to take. And then the fourth nuance that you need to be mindful of is what tax bracket will you be in? You're probably a little confused right now, saying, James, didn't we just go over that? We just went over what tax bracket and how to understand what your income would be comprised of. We did, but we did that for you today under current circumstances. What do I mean by that? Well, let's assume that you're married. When you're married, you have one tax bracket. I know for a lot of people we work with, their concern isn't only, am I going to be okay with my spouse? Are we going to be okay together? But what would happen if I predeceased my spouse? Well, what happens, one of the financial implications is tax brackets essentially get cut in half. So standard deduction gets cut in half, and your tax brackets get compressed. So what happens is even if your spouse maintains the same level of income or even slightly less, if you pass away, they're now pushed up into a higher tax bracket. And it's not unrealistic to think that someone who's in a 12% tax bracket today, if one of them passed away, the surviving spouse, after a couple years of an exemption, so they get a couple years where they get to use the married, filing, and jointly tax brackets, a couple years after that, in the single tax brackets, could be pushed in the 24% threshold. So that's another consideration. We don't have any idea how long any of us will live. But going back to the insurance component of how we view Roth conversions, how do we insure against your future tax liability? How do we insure against a surviving spouse's potential tax liability? And these are all nuances we need to take into account if we want to do this analysis accurately. Now, obviously, if a surviving spouse or if one spouse predeceases the other, income's not probably staying the exact same, but it's also not getting cut in half in most instances. So how do you have some at least elementary understanding of what would that mean for current tax brackets or future tax brackets for the surviving spouse? So those are 4 nuances that I want to make sure you're building on top of your basic Roth conversion understanding. Yes, at its most elementary level, it's understanding where taxes today, where taxes in the future, but we need to add some nuance to that so you can get a clear and accurate picture. Now, make sure that you subscribe to this channel if you haven't done so already. And if you want more great tips on how can you save on taxes in retirement, be sure to check out this playlist here. Once again, I'm James Knoll, founder of Root Financial. And if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.